We want to take a closer look now at the booming LNG market. Kent Moore from the Energy Capital Research Group joins us live from Florida. Kent is expert in oil and natural gas policy and risk management. Hi there, Kent.
Hi, Susan.
LNG, natural gas that is supercooled for easier transportation, could be the leading growing market in fossil fuels in the fossil fuels industry. Since the early 2000s, the number of countries importing it has quadrupled and trade has jumped nearly 30%. What is driving all of this?
Well, there are a number of factors. Underlying all of it is the rising demand for natural gas globally, period. And so traditionally, when you were to service that demand, you were kind of stuck with the pipelines that were coming from sources to your end users in your country. LNG allows you to increase considerable flexibility. By tankering it to a number of new locations, you are no longer dependent upon the traditional export pipeline networks. And that allows to set up hubs in additional areas. It allows you to offset regional risks from one part of the world to the other. And it also allows ultimately to set up reliably based shorter-term prices. The biggest thing that Gazprom has going against it is that it is tied to long-term 20-year contracts, take or pay. You either use the natural gas or pay as if you did. And the price of it is tied to a basket of oil and oil product pricing. On the other hand, LNG, when it comes in sufficient volume, sets up a local hub network allowing for spot, shorter-term prices. That creates greater regularity for the end user market, and it also allows you to balance prices based on competition. And that's the real difference, Susan.
Well, the International Energy Agency is obviously bullish on the prospects for natural gas, but it says there are two threats. One, renewables, the other, methane leaks. What if it becomes more expensive than solar and wind energy?
Well, that is not going to happen. There's a broader perspective we have to keep in mind, and that is we are moving rather strongly toward a new global energy balance. And in that balance, we have a number of traditional and new sources of energy that are coming upon the scene. It is a fundamental mistake, as some analysts do, to start looking for the silver bullet out there that's going to wean us from oil. The real world that is fast approaching is one in which oil, coal, natural gas, renewables, nuclear, all have component elements to play. In that sort of flexibility, the energy prices themselves are going to end up being balanced by the market more so than by geopolitical or by being tied into only one source. And that's essentially positive. Now, with renewables, renewables are the quickest rising sector of energy worldwide. But there are two things you have to keep in mind with renewables. Number one, there is a built-in limitation to how far you can add renewables onto existing national power grids. And number two, since both of these, wind and solar, are intermittent sources of energy, you need to have reliable backup sources of energy in the event that the sun doesn't shine or the wind doesn't blow. And so as a result, with each new unit of renewable added onto the grid, you also have to provide sufficient, more traditional sourcing, and that guarantees that sources like natural gas will continue to rise even as renewables do.
China's goal is to be reliant on 10% of goal is to use natural gas for 10% of its needs, I should say, by 2020. Is this doable, do you think?
Well, there's going to be a combination here. China has been among the leaders worldwide in building a number of new LNG receiving terminals. They also have the advantage of LNG sourcing very close to home. You've got 4 major projects in Australia, you've got 3 major projects in Papua New Guinea, and these are easily accessible by the Chinese market. China also has the largest amount of recoverable shale and tight natural gas in the world. the kind of natural gas that suddenly catapulted the United States to world leadership in gas production, namely shale and tight gas, are in even greater abundance in China. It's going to take a little longer for the Chinese to develop the infrastructure necessary to tap these reserves. But they know they're there, and they know as we move forward into the future, more of the LNG coming into the market and more of the gas that's actually coming from places like Russia by pipeline will progressively be replaced by domestically sourced unconventional natural gas. And I think that's the overall policy.